You do all the right things. You save regularly, you balance risk and return in your portfolio, and you're patient. But when it comes time to retire, you discover, after a lifetime of the right behaviour, that your retirement falls far short of your expectations. How could this happen? In this video, we'll look at ways to make sure it's you that gets rich and not the finance industry. If you find this video helpful, please hit the thumbs up button and subscribe to our channel. So what we're trying to avoid is asking the question just as we retire, where did my returns go? And we can make up a really simple but shocking example of how you can leak return to the finance industry. So let's say that you're in the fortunate situation of inheriting £250,000 at the age of 20. Now you know that on average, the equity return above inflation is about 6%. So you type this into your compound calculator and you think that by the end of a 30-year period, you should have around £1.4 million. So you invest the money and you wait 30 years. Now at the end of that period, the gain should be about £1.2 million, and that's because of the magic of compounding. You get interest on your accrued interest. However, to your horror, you discover that you haven't got 1.4 million. In fact, you've only got 892,000. So more than £500,000 has gone missing. Where did it go? Now, I didn't pull these numbers out of thin air. It turns out that if you're with an expensive platform, an expensive advisor, then your fees can quite easily add up to quite large numbers. So here was an article that was published in CityWire talking about St James's Place, and that's one of the premium wealth managers in the UK. Here you can see that they've broken down the fees that you'd pay for one of their products, which is the pension and investment bond products. So as a client, you'd pay 1.67% as an ongoing fee, and you can see where that money goes. It goes to St James's Place, of course. Some of it goes to the partners of St James's Place. Some of it goes to the fund managers who work alongside St James's Place. But most importantly, it doesn't go to you. So in the rest of this video, we'll look at how we can go from what seems like an innocuous fee, which is just 1.67%, all the way up to losing more than £500,000 in our opening example. Now we should mention that St James's Place has shaken up its fee structure and it's changed its CEO, partly because of pushback from the UK regulator, the Financial Conduct Authority. And as a result of those bad headlines, such as the one we saw from the FT, there were outflows from St James's Place. But once they put the changes in place, the changes in the fees, but also the change in CEO, you can see that they went back to inflows of new money. And in the opinion piece in the FT that went with that graph, the FT made some quite amusing comments. For example, they asked, why are people so keen to pay a premium to invest their money when they can often achieve similar results from a few low-cost tracker funds? The answer, sometimes, wealth management is more about making customers feel wealthy than actually maximizing wealth. The quick recovery suggests that customers were put off more by the reputational stink surrounding SJP than the charges themselves. Well-off clients are happy to pay a bit as long as they're not made to feel like chumps whose money funds corporate jollies at Glen Eagles. So St James's Place's share price has been a bit of a roller coaster. Here you can see it relative to a FTSE 100 tracker, but it's certainly recovering now. So clearly people aren't that sensitive to fees, but as we'll see, perhaps they should be. And a common misconception I hear from clients is that fees are too small to matter. So here you can see the before and after fees from that CityWire article, and it shows what the fees would be for a pension and for £250,000 invested. So the new fee structures are on the right and the old fee structures are on the left. But you might be thinking, why are these numbers looking so large as time goes by? Well, this reflects a really important fact, which is that fees, just like returns, compound. So you pay an initial fee to create the product on St James's Place, but then you pay an ongoing fee which adds to that cumulative fee over time. And it pays to remember that every pound you pay in fees is a pound that will not be compounding for many years. And that's why it's so disastrous when it comes to long-term return. So if we look at a Sankey diagram that shows where the return generated by your investment goes, let's say that in the first year you do generate a 6% return. Well, you'll keep the vast majority of it. So you keep 10k, almost 11k, and St James's Place in this case would keep about 4k. So when you see that, you probably think, well, they're doing a good job, they're looking after my money, I don't have to worry about it, so they deserve a fee. Now let's look at that same diagram added up over a 30-year period, fully taking into account this compounding effect of fees. Well, we can see that the total return, if we'd have got 6% above inflation over that period, would have been over £1 million. The market did its job. However, a very large proportion of that, almost a half of it in fact, has gone to the finance industry. You kept 640k of the gains and they kept 544. Well, suddenly you may not feel quite as generous when it comes to the distribution of the returns. Now for our premium website members, we've got a new tool which we call the Gulp calculator for obvious reasons. But Gulp stands for Gains Ultimately Lost to Professionals. So you enter the amount which is invested, in this case 250,000. Our investment return was 6%. Our fees in this case were 1.67%, and we have a 30-year investment period. So now you can see that 46% of our investment was paid away to professionals. We lost 544,000 and we kept 642,000. So if you want to demonstrate to your family, to your friends, how important fees are, I think this Gulp calculator is a really nice way to do it. Now, if you did want to try out our membership, it's really easy to join up and we're offering a special discount. You can try our premium membership and get 75% off your first month subscription. Simply use the coupon code SAVE75 before July the 1st, 2025, and you get access to all of our premium content. And of course, you can cancel anytime you like, and you'll still gain access to our beginners bundle of courses. Plus you get access to lots of other goodies, including our chat application, so you can ask a question whenever you like. And you can learn more about that by looking at the link in the description below. Now, if you push back about fees to some of these expensive wealth managers, they probably say that they justify the fee by their superior returns. It's often the case that a wealth manager will choose to put you into funds which are actively managed, with the idea that because you're paying more for an active manager rather than a passive tracker, you'll outperform. And this begs the question, do expensive funds get better returns? The overwhelming evidence is that the answer to that question is no. It turns out that fund fees are a very strong predictor of future returns for active funds. However, the correlation is negative. Pay more in fees and you generally get lower future returns. Here you can see that in a report from Morningstar, and you can see they've done that for various classes of equity. The broad US equity market, particular sectors, international equity, but also some fixed income asset classes. In each one of these cases, you can see that if you sort funds by expense ratio, the more you're paying in fees, the lower the expected returns. So that was from 2016. Every year they publish their active passive barometer, and you can see that that shows a very similar picture. The success percentages you can see here in the far right hand column over a 10-year period are whether active funds beat a cohort of passive funds which are in the same category. So you are comparing like with like, an active versus passive. But most importantly, if you compare by fees and take the fifth most expensive fees and the fifth cheapest fees in the active space, the probability of success, which is beating a passive fund, is much higher if the fees are lower. Now, this is a very robust result. It's true for Morningstar's European equivalent of the active passive barometer. And in this report from ESMA, the European regulator, you can also see that there's very little relationship between the fees that you pay and the returns that you get. So investment is very different from other things that you buy in life. If you buy a fancy car, then every time you get into that car, you'll be thinking, oh yes, this is nice. And you really feel the benefit of paying more. However, for the finance industry, perhaps counterintuitively, the more you pay, the lower the expected return that you receive. Maybe one way to think of it is to think of it as a hurdle rate which the fund manager has to beat every year forever in order to generate outsized returns. The higher that hurdle, the less likely they can jump it year after year. So if your advisor tells you that they're putting you into expensive, actively managed funds, maybe push back on that because the evidence is that it's not going to do well for you. What it will do, however, is put more money into the pocket of the financial industry. Or, in other words, is going to increase your gulp index. But it's not all bad news. You don't have to put money into the pocket of the finance industry. You can avoid the dark side of compounding. Firstly, you don't necessarily need financial advice. It is suitable for some people if you don't want to or feel you can't manage your own money. But if you are willing to put in the work and learn how to do it, then it can save you huge amounts of money in fees. The way you pay for advice varies, of course, but often it's a 1 to 4% upfront payment, that's a percentage of your wealth, and then there's an ongoing fee which is around 0.6 to 0.8% per year. And that's for advice alone. Often the advisor will put you onto their own platform, which may also be quite expensive and add to your overall fee. Another really important choice is your investment platform. There are now many investment platforms in the UK where you don't pay any platform fee at all. However, some platforms remain quite expensive. So it's really worth shopping around to find a platform which does the right thing for you. It's not too complex to use, it has the investments you need, but also it isn't going to charge you a huge fee in order to provide that service. And as the amount of money that you invest increases over time, it's often quite useful to switch from percentage fee platforms to fixed fee platforms. And to a certain extent, your behaviour on the platform can also be modified to reduce your fees. For example, if you trade a lot, even though there's no commission perhaps on your platform, you're not being charged for the trades directly, but there will be a bid offer spread for the things you buy and sell. So if you trade a lot, you'll be crossing that bid offer spread, and that can erode your wealth. So by trading less, you can reduce those fees. If your platform does charge you a trading commission, then clearly there's a big incentive not to trade. And a fee people often forget about is their currency conversion fees. If you're buying an asset in a foreign currency, you're often being charged a percentage on top of the bid offer spread for the currency market. So it pays to know what that is, or ideally stick to funds which are denominated in your own currency. That's what I try to do, and often you'll find that there is a sterling denominated ETF which gives you the exposure you want. That way the fund manager will do the conversion much more cheaply than you can. Another way to save money is to choose funds which aren't expensive. Now it's often the case that passive funds are much cheaper than actively managed funds, which is why the emphasis of a lot of my videos is on those passive funds. So if you're paying more than about 0.15% for a fund, it should be doing something really special. And although we don't think of tax as a fee, it is kind of a fee, and you can quite easily avoid it in the UK up to a certain limit by using an individual savings account, an ISA, or a self-invested personal pension, a SIP. Plus, we've got tax breaks for things like gilts, where you don't pay capital gains tax on gilts. So if you have got money in a general investment account, you can minimize your taxes by using these low coupon gilts that don't pay out much income. So by making these changes, you can avoid paying high fees. And I think nowadays you can quite easily get your overall expenses down to less than 0.15%. If we go back to our gulp calculator and work out how much is lost to professionals, if we drop our fee tenfold from 1.67% down to 0.15%, we can see that gulp goes down to just 5%. You can see that now the dark shaded region, which is how much of your returns you keep, is much higher, and only a sliver is going to the finance industry. So if you haven't done so already, I really strongly suggest that you work out what fees you're paying. If it's a workplace pension, that's often quite tricky to do, but for your own investments, it's much easier. And see what a huge difference it could make if you do reduce your overall fees to something which is closer to that 0.15%. If you do know people who are paying a lot for active management, then perhaps suggest they should work out their own gulp index. Now, if you did want to join our community to try it out, remember we've got this special offer before July the 1st, 2025. Just use the coupon SAVE75 to get a 75% discount on your first month's membership. So that's SAVE75, uppercase, all one word, and you can find out more about that in the description below. And, as always, thank you for listening.